like having a bit of cash flow for when the market dips. There's nothing nicer when the market goes down. You have some consistent income that you can combine with your working income to really drive down into those lower market periods. I found that I'll kind of framework my portfolio first and then kind of talk about some of the strategies that I implement to outperform that have worked favorably for me in the past. But at this stage, and again, I didn't used to be like this. This is a decade of investing and evolving and getting to $1 million and all this stuff. But ideally, the point is that I like focusing most of my money in index funds. At this point, I just started buying XEQT and some of the global market funds. They're still very small percentages, but I do like the idea of wealth preservation as my portfolio scales. But at this point, like we're about 50% the S&P 500, very easy. We've got about another 20%, 25% sitting in the Canadian markets just to collect some cash flow, and then a little bit more into XEQT. And then about the other 20% is just purely in individual stocks. We're a lot younger. I feel a lot more confident, especially because we've been very fortunate in the markets, investing for a while. Like we can take on a bit more risk than maybe the average investor. And then I also have what I would consider in that 20%, what I call my long shots, which are some more speculative, smaller cap companies, some of which I do tend to work with. These are a whole different basket that are highly scrutinized. Obviously, small caps are very kind of, I don't know, they're shunned a lot in the current market environment, but I do find that if you find the right companies and you work closely with them and stuff, that you can still see some pretty excelled returns in those with very small amounts of money. I call them kind of long shots because you put a little bit in, and if it works out, that little bit goes a very long way. And if it doesn't, it barely, you don't even notice it. But yeah, and I prefer, and on YouTube, most people are excited because they don't want to talk about global market funds or VT. That stuff's boring as hell for most people. But yeah, it's that 20% that I love to focus on. It's where my passion is, like you. I like finding things I believe in. And the only two strategies that I'm able to implement that have worked successfully for me and outperforming is I am excessively good at very volatile market and chaotic market events. A lot of people, and I've said this time and time again, when my family and my friends are calling me about what the hell's going on in the market, that has always been the best buying indicator that has made me. We recently, just over almost a couple years ago, bought a condo in Toronto. And the only reason we were able to afford this was because of the pandemic. And I lost my job in the pandemic. I was one of those people that got royally screwed. I was very fortunate because, well, I'm not married. I call her the wife. We're engaged. But at that time, she had a lot of cash. I didn't have a lot of cash, but I had a line of credit. This is the first time I ever used debt or margin in the market ever. And she was sitting on like a lot of cash. And I was like, this is ridiculous. Like, we're going to go open another brokerage account. We're investing all of this shit this week. Like, this is crazy. The market tanked so fast. And I was just like, oh my God, what an opportunity. So, I mean, we were buying speculative stocks. Like we made 1000x gains on things like really highly speculative investments. She bought her Meta position at the third week of March, the bottom of the pandemic. She's still holding the same position. We've built on it a bit more now. But like the stock, we were just buying anything and everything, like indexes, individuals, like just going nuts. And oh my God, leading into 2022, the rest is history. I remember in 2019, I hit my first 100K, and it took so long to get there. And it's crazy that from 2019 to now that like our combined net worth is far surpassed, a million. That's Canadian dollars, might not be worth as much in the United States, but to be 33 and to be in such a privileged position and, have an affordable living in a very expensive city feels pretty blessed. But I got to keep reminding people that you get rich when the market crashes. It is the absolute prime opportunity, and people just psychologically can't handle it. And it's why I kind of roll back to what Dave Ramsey says a lot, that most people shouldn't manage their own money. Because I do emotional shit a lot of the time, and I've made some pretty big mistakes selling the bottom of stocks that I shouldn't. Even in 2022, I would have been better holding those stocks, but I recognized that I didn't know what was going on. I'm not comfortable with this. Let's just put it in indexes. Let's ride this, see how it goes. I cost averaged. People forget that crash was really bad. And now we're back in a highly speculative market where crypto, everything's running again, and people are getting very laxed with valuations. But if you remember 2022, man, like SPAC market got destroyed, NFTs got destroyed, crypto, altcoins destroyed. Meta, again, a mega cap company dropped 70%. And you got to sit here and ask yourself, that is the opportunity. Like you, can you recognize the value in the market and get rich off of it? Or are you going to freak out like everyone in my comment section and my family and my friends that are calling me? I want to go in cash. I don't know what's going to happen. Let's sideline this for a bit. And then what's the quote? If you miss the handful of days in the market, you miss out on like half the total returns. So you don't know when those days are coming. But what I do know is I have a job. I can make money. I have access to capital. Go nuts. Like this is when the shopping spree is going to yield the best results. And I mean, same with Meta. Like you just said, you didn't buy the last dip. I bought the Meta dip and I'm already up 30%. Like when you recognize the value in these drops in this sphere, like Google right now, it's one of the reasons that I'm obsessed with Google. It's like the number one position in our portfolio. It's the largest investment I've ever made in my life on an individual stock basis, is purely because it's down a lot. It's too damn cheap. And people just, they're getting caught up in clickbait. It's kind of toxic for newer investors, and not everybody is mentally prepared for individual investing. I don't think there's something wrong. I don't think there's anything wrong with paying a manager 1% if it stops you from blowing up your account when it matters most.
I agree with you on that. I think because I think most new investors do make emotional decisions and they panic sell on the downturns. I think probably why I know myself and a lot of pretty like ethical YouTubers, we tell new investors just to buy an ETF as well. None of us promote buying individual stocks like, oh, Jesus Christ, they're just going to freak out. Or they're going to pick the wrong stocks, or they're going to read something on Yahoo Finance or like the Motley Fool and see a stock getting pumped, buy it, and then it drops 20%, right? Because they got fooled. Like there's a million different things that can go wrong. So when you're looking at your foundational ETFs, what are you using? Is it all US based ETFs?
It's all S&P 500. Like that's half our portfolio. I can't find a better ETF that I like. So the thing is people are like, why don't you buy the Qs or something? And the problem is I don't
Mhm.
like the Qs are incredibly concentrated in a lot of companies that I think are incredibly overvalued. I wouldn't be buying Tesla. I wouldn't be buying Costco. There's a handful of companies in there that I'm not 100% sure of. But like you, I have a great deal of confidence in some of these top weighted companies like Meta, like Google. And I would rather just say, hey, instead of putting it into the queues, let's just pick a few of these companies that we really love and hope that it works out. Because again, if it doesn't work out, it's not going to completely ruin our retirement by any means. But I like the S&P though. I love market cap weighted systems. I do not think there is a better system to implement out there, because again, there's no emotion involved, there's no backdating, there's no, oh, value this, value that. If the company's overvalued like Tesla and it continues to be in perpetuity, hey, I'm still going to get the upside from that regardless about how I feel about the company today, right? Because even though companies can, like, look at Nvidia is a great example. I couldn't wrap my head around Nvidia, and everyone called it a bubble, and I called it a bubble because when the stock was going parabolic, there was clearly insider information that you or I did not have. That stock
Yeah.
was going up tremendously before earnings, and I'm like, how is this company trading at what, it peaked at like a 200 or 300 times multiple? I'm like, how is this even possible? They don't have the growth to justify it, and then somehow in the next 2 quarters, every time it was doubling its earnings. I'm like, how is this company doubling its earnings every quarter? That doesn't make any sense. I mean, like, so I would have missed that completely, but because I hold the indexes, which you might recall, I think the S&P, most of its gain that year came from Nvidia, which was
Yeah.
like, and I would have missed it completely because I just couldn't wrap my head around it until after it happened. And then like, so you can't know all that stuff, and you don't want
I
to
was
miss
in the
it.
same boat as you with Nvidia. I didn't understand it either. I was like, "What's happening here?" So I didn't buy it. I was like, "I don't want. If I don't get it, I don't buy it." And then so is it VOO that you hold for your S&P
Yeah, and I
500?
hold it in US dollars and US accounts, so I don't have to worry about dollar conversions or this or that. I like having I've been really debating, and this is just because of my pure paranoia, is opening up multiple currency accounts and buying international stocks, either through emerging market ETFs that are fixated more on other currencies. So like I would love to buy some European companies. I was really kind of, I haven't bought them. I like looking at them like Nestle and Hershey. I haven't looked at them recently, but they crashed so hard. And I'm like, I would love to own those things in their native currencies.
So like buying it on like the London Stock Exchange or something, you
Yeah,
mean?
I
Index?
love multiple currencies because as a Canadian who travels quite a bit here and there, like I recognize that the one of the biggest double-edged returns I ever had was putting all my money in US dollars and US dollars accounts. And I did that very early on in my investing career. And the dollar, since I've been investing over a decade, has dropped tremendously. So, now it's a bit of a concern because the US dollar is starting to drop. So if you're just investing now, you might not see the best return because the US dollar, I think, has already dropped 5 or 10% or something. So it really
Mhm.
sucked if you caught the top of that buying Google or something. But again, I'm a long-term investor. I don't care about the short term. What I do care about is, again, preservation and diversification. And I recognize that currency risk is a big deal. If you live in Canada, you've experienced currency risk. Canadian dollars dropped tremendously over the last decade. So I like the idea of having multiple currency accounts and generating currency from around the world. Because if you live in Canada, I always say Canada wants you to be rich. It is the easiest country to make money globally and not get taxed on it.